than them to throw some light on where things may be headed from here. Gentlemen, hi, morning. Mr. Surana, if I could start off the discussion with you firstly. Stick your neck out for us. I mean, after being at that $60-$65 per barrel range for quite a few months, we're now looking at very elevated $74-$75 kind of mark on crude. Where do you think crude prices are going to head from here, provided things don't abate in West Asia?
So in last 4-5 days of conflict, what we know now is that so far the conflict is mostly remaining contained between these two countries, and Strait of Hormuz has not been affected as far as supplies are concerned. So I would assume that with all the clamor which is going for de-escalation there from all over the world, I think that the negatives up to this level of conflict are already built up in the price of $74-$75. And as far as there is no further escalation which engulfs more countries, or there is a supply disruption in Strait of Hormuz, I think this is the price range where the current conflict stays. And it will move around this. Maybe that sometime you may get a spike, but unlikely to go above $80. Even if the conflict between these two countries continues for a longer time, but provided it doesn't escalate further. The possibility of the Straits of Hormuz supplies getting affected is low, generally, that is what it is believed, because historically in many of the conflicts, even more severe conflicts than this, the supplies continued from the Strait of Hormuz, and also because the 1/5 of the oil passes through this, all the other countries in the Middle East who are the oil suppliers, they are also quite dependent on this. And therefore, I believe that the regional superpowers will prevail, and even US will prevail to ensure that the supplies through Strait of Hormuz is not affected. Now, if that is the situation, then I would believe that over a period of time, let's say of Q4 of this calendar year, the prices should be back to 60-70 range, because there is no fundamental reason why the prices should be above $70. And there are more reasons for that, because of the escalated supplies from OPEC, almost 3 times what they have originally thought of. Most of the oil supplies out of the 2.2 million barrels voluntary cuts would be there in the market, let's say by that time. Also, the summer driving season, which is normally a high demand season, would have come to end. And the substantial part of the risk premium, which is built up in this price, would have come down because of those risks not materialized. So I would think that currently for some time, let's say this Q2 and Q3, there may be higher prices in the range of 70 to 80 or so, but subsequently it has to come down. And also because the demand concern still continues to be there.
Right.
And though there are talks that the Q2 is going to be, the H2 is going to be better than H1, but still those concerns continue. So I would think that the oil going forward range Q4 onwards should be less than 65.
Okay. Probal, how about you? Because your base case for FY26 for Brent was about $68 per barrel, right? Would you be revising your estimates to factor in the recent geopolitical turmoil?
No, I think, at this point of time, it's too probably premature to take a call in either direction in terms of where crude will end up. Obviously, we have looked at sensitivities and very clearly, with the spike that has happened, even if it were to stay at 75 odd dollars, that does have a material impact on our base case retail margin assumptions for the OMCs, and has a positive impact on the other side as far as upstream earnings are concerned. Because even earlier, when crude had spiked in the aftermath of the Russia-Ukraine conflict, the government stepped in only when the price went above $75 and stayed there for a while before imposing windfall taxes. So at the bare minimum, if you assume that 74 to 75 is allowed, upstream benefits, but OMCs very clearly every 2 to 3 rupees retail margin decrease can have as much as a 30-35% impact on their EPS. So it's a major risk on upside as well as downside. But at this point of time, as Surana sir was saying, given how fluid the situation is, I think and given that the market fundamentals still support a bearish environment as far as crude prices is concerned, the key monitorable therefore really is how much does this conflict actually escalate, number one, and does the escalation actually get the Strait of Hormuz into play in terms of actual disruptions? Because if you remember, India actually is impacted more than a lot of other countries on both the oil and gas fronts from the Strait of Hormuz. Almost 40% of our imports reportedly come through this route into India, and almost 50% of our LNG imports. Also, since the largest contract we have is with Qatar, that also flows through this particular strait. So both of them can actually, see an impact. With 3 days in, 4 days in, if we start to change estimates, I think we'll have to change estimates every week, at this point of time. So we are sort of in a wait and watch mode. We have put out sensitivities in a note that we released a couple of days ago in terms of what the impact could be. But as of now, we would want to sort of look at really, how this conflict plays out before taking a definitive view on, where the crude price estimates could be for the full year.
That's about how the crude oil prices will impact the different players related to that. But Mr. Surana, if the prices sustain at these elevated levels, we can't rule out the possibility of a retail fuel price hike as well, isn't it? Help us with your view. What implications can this surge in the crude oil prices have on the consumer retail?
So the crude price, the pump prices in the domestic market has remained static for quite some time. Of course, some management was done with increase and decrease of excise duty. And if we go by that premise, I think unlikely that the pump prices will be hiked in the immediate future unless the crude prices remain above $80 for a reasonably long time. If it is just a spike to that level and back to below 80, I think the pump prices will continue to be in the range which is there or the way it is. Also considering there are elections in some of the states, I think there is a lesser chance of pump prices being increased. Of course, there was a clamor for reducing the pump prices because there were the OMCs marketing margins were reasonable in the recent past. So that possibility right now I don't see of reducing the prices also because the margins would have impacted because of increased crude price. Now, as far as the LPG under recoveries are concerned, there is still a concern for the OMC. And I think that government still have got a lever in the form of excise duty to manage the pump prices remaining constant, even taking care of the financial health of the OMCs. So I would believe that the prices will remain so unless we are seeing a major escalation which pushes the crude prices above $80 for us.
Right, Mr. Surana, I also wanted to get your understanding on our relationship with Russia. Around 30% of our oil requirements are met from Russia. What should be India's strategy for oil purchases given the geopolitical tensions now, and what's your take on that?
No, India has maintained a very fine balancing line as far as our interests are concerned and the geopolitics are concerned. And that has led to a reasonable diversification of our crude sourcing. We are getting crude from Russia, from America, from Africa, from Middle East. And that augurs well with India. And we should continue on that line to ensure that we are well supplied and our sources are diversified. And we are able to take the advantage of the pricing also to the extent it is available to us. Now, of course, there are some news items for European Union trying to reduce the cap price on Russian crude, but let's see how it develops.
All right, but along with that, Mr. Sen, just wanted to have your take on what the implications could really be when it comes to the OMCs, and especially your take on the valuations as well, because the chatter that still persists in the markets and what these analysts have been highlighting is that, yes, of course, the crude volatility is at play, but if we look at the valuation, some of these stocks like hpcl, bpcl, they are really trading cheap. So since you also believe that this uncertainty should subside in some time from now, you're not changing any of your estimates or the base cases, rather, this valuation picture still looking good?
Oh, yes, absolutely. If we look at our estimates, and obviously, admittedly, at this point of time, those estimates can come under pressure. But at the current level, all the three OMCs are trading between 5 to 7 times 1 year forward earnings. I'm saying when I say 1 year forward, I mean FY27, there or thereabouts, which is obviously a fairly attractive level, specifically after the fall that they've seen in the last couple of sessions. Also, I would just like to add that, while we are talking about the retail price, impact, and as Surana sir really said, that the chances of pushing through a price hike will probably be remote. Therefore, the $6-7 hit, if one has to take, that alone counts for around a 3-3.5 rupee hit on the current retail margins, which are at about 9.5-10 rupees. So even after taking that hit, the margins at 6 rupees will still be well above historical levels. And if prices do increase and product prices catch up, you could also see a short-term impact in terms of higher GRMs and some inventory gains as well. So, which is basically what makes it very difficult to take a definitive view right now on what the earnings could look like, and that is what makes us still a little bit optimistic that once the storm really settles down, as long as prices don't go completely out of whack at $70 to $75 or even at $75-77 range, we still see a lot of value in these stocks from a long-term perspective.
Probal, very quickly before we let you go, what happens to refiners, your IOC, ONGC, Vedanta, etc.?
Yeah, so if whenever prices do rise in this environment, given that it's geopolitical worries that are driving it, product prices may not actually rise in perfect correlation because the product demand on the ground is not really changing. Having said that, there will be some correction upwards. And what we have been seeing in any case over the month of May is that GRMs have actually recovered quite at a healthy pace. Singapore GRMs are anyways at $6.5+ if we look at Q1 FY26 average till date. So one would expect that, on the GRM front, you could actually see a little bit more of positive delta. And at least for the first quarter, given the sharp reaction that the prices have seen, you could probably have an inventory impact as well on the positive side, at least in the refining business.
Okay, Mr. Sen and Mr. Surana, thank you so much for taking the time out and joining us on ET Now today with that discussion. And on that note, we'll let you go. But time now to shift focus and talk about the IT space. The recent run-up in Nifty IT has been something to talk about. It's been the chatter on the street